Hello everyone, welcome to my second video on interpreting financial statements. This time I'm going to be talking about the balance sheet or the statement of financial position. Now, the balance sheet is a snapshot of what the business owns or owes at any given period in time, or at a precise given period in time, I should say. So it's not over the course of a year or a month or anything like that. It's at that precise moment, what does the business own and what does it owe? And the balance sheet sets to put that out in a very logical, official format. Again, it has to be published by private limited companies and PLCs for a variety of reasons. So I'm going to talk you through what some of the components of the balance sheet are. So to start off, we always have the non-current assets. So these are the long-term assets of the business. An asset is something positive that a business has, something that it can turn into wealth should it need to. And it's anything that the non-current assets are anything that the business will not turn into cash in the next year. It's something that it owns. So for example, this is for a large supermarket, an example that I took from a textbook. So they've got property in a value of, these are in millions, so 32,200 million. So it is they're very property rich business. Those are their non-current assets. Okay, coming down from there, we have the current assets. So these are the sort of things that they're what we call highly liquid assets. They're things that that are cash or can be turned to cash very easily in the next year. And we have three examples of this. For example, we've got stock. That's things that, in the case of this supermarket, that might be all the tins of beans that they own, for example. All of the chicken, everything that's on the shelf is stock, which they would expect to turn into cash in the next year. Note that with current assets and stock, it's the value of it that it was purchased for, not the value that it's going to be sold for. And that's really important when looking at some businesses. So this is the value at which the business bought its stock, not the value at which it sells for. So it doesn't take into account its profit in that sense. Moving on, we've got debtors, I should say. Debtors are people who owe the business money. Anything that's been bought on trade credit from that business or anything like that, we call debtors. So people who owe the business money, usually that's given out on a 3-month credit basis. So we do expect debtors to turn into cash in the next year, so making it a current asset. Following that, we have cash, the most liquid asset of all. You can use it as you will. So this business has 2,700 million pounds worth of cash. Going on from that, we have current liabilities. So these are bills and things that the business must pay in the next year. So our examples of this are creditors. So people, when it was buying that stock, they probably didn't pay for that stock up front. They got that stock with an agreement from the suppliers that they would be paying them back in 3 months. And the best example of that is, that's what we call our creditors. So credit is someone who you owe who the business owes money to and will be paying it back within the next year. We also have an overdraft. So that's where if your bank balance goes below zero, technically you owe your bank money. Many of you, when you become students, will no doubt get a interest-free overdraft, but it's something that you will eventually have to pay back. Businesses can have them as well, and it's expected that those overdrafts are paid back within the next year. Having a large overdraft can be a big issue because usually they've got a high interest rate attached to them. Moving on from that, we also so I've put this item in red here. This is what we call our net current assets. Yeah. So this is all of our current assets minus our current liabilities. And that shows the ability of the business to pay its short-term debts. As you can see here, this number is very low. In fact, it's negative 7,800 million. So what that means is this business is going to struggle to pay its short-term debts. Yeah. So that's what we call working capital. So your current assets minus your current liabilities becomes your net current assets, which is called working capital. Moving on from that, we have the non-current liabilities. So that's the long-term debts of the business. And in this case, we've got our mortgages, so that's debts which are secured with a house or a property as collateral. So if the business can't afford to keep up its payments with its mortgage, the bank will come in and take their property. So that's the bank is using that as collateral. So using the property as collateral, long-term debts will be paid back in more than a year, I should say, and long-term loans. Okay, so beneath that we have the net assets. Now the net assets is all of the assets, so both the non-current assets and the current liabilities. Non-current assets and current assets. So all of those added together, and then we take away our current liabilities and our non-current liabilities. So it's all the things that the business has minus all of the things that the business owes. And that gives us the net worth of the business, how much everything the business owns, or the value of that business. So in this case, it's 7,100 million. So that's the net value of the business. So that's one side of our balance sheet. On the other side, we've basically got where all of the money came from to start this business. So, and that comes in a section that we call equity. And there are usually two components of this. We have share capital and reserves. Now, share capital is all the money that was earned or made by the business when they sold shares. So, perhaps when a large supermarket is floated on the London Stock Exchange, for example, people can buy shares with it initially from their initial share offering, and all of the value of those shares, all of that money goes into the business, and that's where the share capital comes from. The other part is the reserves, which is all of the money that the business has taken as retained profit. So all of that money that it's made as profit in the past and then is reinvested into the business, we call reserves. And if we add these two together, we get our total equity. So that's all the money that's gone into the business. Now, if we take there's a very key thing here. Your net assets should always equal your total equity. And that's why we call it a balance sheet, because everything has to, those two figures should balance. And if they don't balance, there's something wrong with your balance sheet. So, let's talk about some of these things, a little bit of a recap. So, our current assets minus our current liabilities. So our current assets minus our current liabilities are the working capital and the business's ability to pay its short-term debts. As we can see with this business, they're going to struggle to pay their short-term debts. So net assets here is the total value of the business, and the net assets must be equal to our total equity, because this is all the money, all the things that the business has money invested in, and this is essentially where all the money came from. So those two figures must equal each other. Okay, there are some limitations with the balance sheet. It doesn't tell us anything about how profitable this business is. It doesn't tell us whether this stock is going to be sold and at what price, and whether that's going to help them in paying off their rather large net current assets shortfall, and doesn't tell us anything about the market position of the business, or what their profit levels are like. It just tells us what they own and what they owe. So there are limitations in that, and it's useful to a number of parties. If you wanted to buy the business outright, I'm going to buy the entire supermarket, you'd want to know all of their debts and what they own and what they owe. And you could see that by looking at the balance sheet. So the balance sheet is really useful for that. If you wanted to lend this business money, you would want to know how much debt this business is already in. So you would look at things like the the non-current liabilities, and you would look at the current liabilities, and you can see how much they owed. More importantly, you could kind of see what their current assets are like. So what their kind of ability to pay you back is like, what their non-current assets are like, because this is the sort of thing that, for example, if you were to take out a mortgage, you'd want to make sure that that business had something that they could give to you in the event that they couldn't pay their debts. So the fact that they've got this amount of property means that they've got something, they've got collateral that they can lend against. Yeah, and also if you wanted to invest in the business, you'd want to know that the business was in a good financial situation, which you could assess from this. Anyway, I hope that's been useful. We're going to use both of our financial statements in order to do some ratio analysis. So looking at the health of the business in terms of ratios. So I should be looking at that in future videos. You need both the balance sheet and the profit and loss account to find most of the figures for what's coming up. So make sure that you're really familiar with these going forward.